Hello, everyone. This is Neil Borate. I'm deputy editor at Mint, and I'm very proud to announce the release of our first ever compilation of personal finance articles by Mint Money, by the Mint Money team, uh, particularly articles which have infographics. So, over the past few years, our infographics have dominated the conversation. And we often get requests on social media, why don't you put them all in one place? So we have labored over the past few months to do exactly that. And in this book, we give you 20 concrete, actionable insights into personal finance. They are strategies that you can use, um, and that forms the core of this book. Um, Joining me today is our partner for this launch for this book, GoalTeller, which is represented by Vivek Banka and Pankaj. They should join us shortly. Hi, Vivek. Hi, Pankaj.
Hi, Neil. Hi.
Hi, hi Neil. Hi everyone.
Hi, hi. So, fantastic moment. I think culmination of many months of effort, both from GoalTeller side and from ours. So you will find that there are several chapters that come from GoalTeller's original research. They are a SEBI-regulated investment advisor, and of course our own Mint infographics. Um, so what I'll proceed to do now is to take you through the structure of this book, tell you a bit about what we are giving you here, and then discuss some of our personal favorite personal finance strategies as well as the portfolios that we have shown here. So is that okay with you guys?
Yeah.
Yeah. All right. So I'll just share my screen. Yes. Is my screen visible properly?
Yeah, it
Yes.
is. It is.
Right. So as everyone can see here, this is how the book looks. The title page. It's 20 personal finance strategies that you can actually use, practical strategies that you can implement. Um, Apart from this, you will also find Guru portfolio infographics. So these are the personal portfolios of fund managers, of leading industry professionals, of investment gurus. And it's unique because unlike traditional interviews, which just ask people where should you invest or what do they think of small caps or XYZ company, we ask people what it is they actually do with their own money because actions speak louder than words. And we do it year after year. This is the fourth year in which we are speaking to the leading voices in finance in India about how they manage their own money. So you will find across the book, we have presented to you a varied set of guru portfolios. Um, Apart from these two, you will also find columns by leading industry professionals. So Rajiv Thakkar of Parag Parekh Mutual Fund gives you his take on investing. You will also find a column by Radhika Gupta. And apart from investing, you also have insurance. So Mahavir Chopra, who has a insurance fintech, he has given you some excellent insights into insurance. So I do hope that you enjoy this book. It is sort of not just something that we've put together in terms of our articles, but we have actually collated the articles that we think you need to equip you for making your money go further. So with that, let me now discuss some of my favorite personal finance strategies, and then we can get in Vivek and Pankaj to talk about theirs. And in fact, the very first chapter is one of mine. So a lot of you might be sitting on gains in your stock portfolio or your mutual fund portfolio, and a lot of people aren't aware that if you redeem your funds and you don't own more than one house, then you can actually reinvest the proceeds into buying a house and you can get a tax deduction on it. That is the beauty of Section 54F. People popularly think that if you sell a house, you can buy a house, and that's how you save tax. But actually, if you sell mutual funds or if you sell stocks against those assets as well, you can get the benefit of 54F. Um, Vivek, anything you'd like to add on this? Investors you've talked to who've utilized this provision, or any feedback you've got.
Yeah, so I think over the last many years, of course, we are not very bullish on real estate as an investment lately, but there are a lot of ways that people do not realize that taxes can be saved. For example, as you rightly said, in case if you sell, if you are subject to any kind of capital gain, long-term capital gain, short-term capital gain, people are not aware how these can be offset. So long-term capital gains can be offset against long-term capital gains. Long-term capital losses can be offset against long-term capital gains. Short-term capital losses can be offset against both short and long-term capital gains. This is one part of it. Second part of it, as you rightly said, if you've got capital gains, you can reinvest the proceeds into a residential house. And if that is done to the extent of the investment that you do, the gains are exempt. So, for example, if you've got 1 crore from the sale of some unlisted shares, if the same 1 crore is invested into a property, then you don't have any tax liability. However, there are two, three things which you need to keep in mind here. One is that you're only allowed to do this if you've got only one house right now, which means that you can own 1 plus 1 residential house, and you cannot own more than that. The second thing is that in case if you do not have the option of buying a house right away, but you wish to buy it over the next few months, etc., then before the next tax filing date, in which case right now is July, you need to ensure that the money is kept or parked into a special account by a PSU bank, which is called a capital gains account. And so even so, up to 2 years of the sale of the asset, you can continue to buy a house and you will still get that exemption. But until that 2 years, your money cannot be parked here or there. Before the tax filing date, you need to park it into a capital gains saving account. And most importantly, I would also recommend people to do this only if they are keen to buy real estate, if they like the property, etc. They should not buy it purely because of saving taxes. Because a lot of times it's like frying pan into the fire. People buy another house which they do not like, they have no clue about, and end up making a bigger mistake than what they would have saved the taxes on.
Yeah, absolutely. Another favorite strategy of mine is the one about HUF. So you can set up an HUF, and this effectively doubles your tax deduction because the HUF is considered as a separate taxpayer. So you can utilize Section 80C twice, you can utilize medical insurance deduction twice, you can utilize NPS 80C 1B twice. So a lot of advantages come in. Also, capital gains exemptions get doubled. So across the board, there is a huge benefit to it. Of course, there is a catch to everything. There is always a catch in finance. So I'll let either Pankaj or Vivek come in on and explain that catch.
Yeah, so there are a few things, a lot of people at GoalTeller, a lot of our users come and ask us. In fact, that's a very, very commonly queried topic, how to create a HUF to save taxes. So HUF is like a separate entity that you get where your tax savings happen because the income on that will be exempt up to 5 lakhs, or, it will be at a lower tax slab. So if I'm right now paying 30% on my income, any incremental income on my account will be taxed at 30% because I'm the highest slab. But today, if I have another HUF and some investments are through the HUF, all the income in the HUF will first, the 5 lakhs will not be taxed at all, and then so on and so forth. But the challenges in a HUF, or not the challenges as such, but one thing which people need to really bear in mind is that I cannot infuse money into my own HUF. That is not legitimate. There are certain people who can infuse money where you can get it as gifts. So there are certain lineages in terms of your descendants, like your father-in-law can do it. You or your spouse cannot infuse money into that. So one has to speak to their own chartered accountant and understand which lineage in terms of your family lineage can infuse money into the HUF, and through that it can be done. Because if you infuse money into the HUF, the income will be clubbed with your tax at your tax slab. So the whole purpose is defeated. Pankaj, in case if you've got anything else to add here. Pankaj, you're on mute.
Sorry. Yeah, I was on mute. Sorry. I think Neil and Vivek, you both have covered the benefits of HUF for an individual quite well. My only one point would be, uh, I mean, we all need to be very careful for creating many different structures for it. Unless you see it's not going to be benefiting you in the larger extent, one should try to limit, tax to one entity. Many times we just create structures for the small benefit, but in the longer term, it's not that great beneficial. But yes, it's a very great structure for HUF. One should really look at, discuss with financial advisor and tax consultant, and take it forward.
Yeah, absolutely. So these are two of my the two tax strategies that I think are the most interesting. I'll now turn to two mutual fund sort of ideas or insights into the way they function that we've documented in this book. And in fact, these happen to be two of today's most popular mutual funds. If you look at flows, most of the money is going into these two. So it's really important for investors to understand what it is that makes them tick, what is their philosophy. So the first mutual fund I'll turn to is Parag Parikh Mutual Fund. Um, Parag Parikh has always stood for a certain strong value investing philosophy. They have devoted a part of their portfolio to international investments as well at a time when nobody was interested in investing abroad. And that stood them in great stead when the US performed, when US tech stocks performed, and the Indian market was not doing so well. But the essence of Parag Parikh, especially the flexi cap fund, is the Swiss Army knife strategy, meaning that it is an unconstrained fund. It has the freedom to go anywhere because it doesn't limit itself to a particular segment of the market, like let's say a small cap fund or mid cap fund. A flexi cap fund can, if it wants to, put all of its money into large caps or all of its money into mid caps. There is no regulatory restriction on where it can go, and that gives them enormous flexibility. They can also put up to 35% of their assets into international stocks, an ability that's currently restricted not by design or by their choice, but by the RBI limit on overseas investments. But whenever that limit is raised, again, this fund will get back this flexibility. So to a lot of people who are confused that should I put money in small cap, should I put money in large cap, it's a perpetual debate. And now, especially in this market, when we see small cap and mid caps running up so much, it's a particularly strong thought in investors' mind. Should I rebalance, which incurs tax? So Parag Parikh has this great feature, this great philosophy that the fund manager will take that call, and if it's done inside the fund, then you as an investor you don't have to pay any tax. Um, so I'll stop here. Vivek and Pankaj, you'd like to add something about Parag Parikh's strategy?
Parag Parikh, so Neil, we are actually going to introduce over the next few days on a public free platform something called a GoalTeller score, where possibly unlike a lot of other platforms, we measure this score on 4 parameters. First being rolling returns, second being consistency, third being volatility, and fourth is the fund house score. We actually attribute based on the lineage and the AUM score to the fund house also. So over the last many quarters, many years, in fact, last couple of years, Parag Parikh has stood right on the top. And for people who compare Parag Parikh with other fund houses, possibly like a Quant or something, nothing to take away from Quant. They've done exceedingly well, and credit where it is due. But one has to understand the volatility is very different. So, for example, if a quant fund has a volatility of 21, 22%, or a small cap fund in the same zone, a Parag Parikh has approximately around 16%. So the volatility for everybody who's hearing this is the deviation from the mean for in terms of the return. So the average return is 16%. the volatility signifies that the returns could be 16, minus 16, or plus 16 at different days. So that's how what the volatility signifies as to what is the range of returns over the past 3 years, 5 years, or whatever period that volatility is calculated on. So that way, I love Parag Parikh as a fund house. Secondly, I love the fact that they take good cash calls, and they're one of the few people who stick to cash calls despite seeing short-term negatives on their portfolio because of the cash call. Secondly, we get a free international exposure without the inefficiencies of the international taxation. So, because of all of these factors, I quite love Parag Parikh as my top pick in terms of evergreen active funds.
Yeah.
Nothing more from my side on this, Neil, Vivek.
Yeah, absolutely. So, apart from the strategy that they epitomize, which is the Swiss Army knife, and we've shown through our study of the top performing funds in different years, the way they rotate, that the more you try to go thematic, sectoral, pick niches, that will go in and out of fashion. And in order to pick the winner every year, you will have to keep rotating, incur taxation, and that's assuming that you get it right. Most likely, investors are going to get it wrong, and this is going to add to underperformance. So, for a lot of investors, this kind of open sky Swiss Army knife can work really well. The other fund house that we've talked about, of course, is Quant, which gets a lot of flows these days. And Quant is interesting because it is essentially a trader wrapped up in a mutual fund. If you look at the turnover ratio, the amount of stocks that Quant keeps buying and selling, it is way above what any other mutual fund does. And that's because of their trading outlook, their trading philosophy. And this has worked really well for Quant's investors. Um, why? Because ultimately the costs that come with trading, particularly tax, they don't get incurred because of the mutual fund wrapper. The mutual fund itself is a trust. It does not pay any tax on the profits that it makes, unlike what you would do if you had directly started trading yourself. And you, as the mutual fund unit holder, you don't pay any tax until you decide to redeem the units in your fund. And these can be at whatever point of your choosing. In any case, they can certainly be after a year, which drops your tax rate from 15 to 10%. So that's another interesting animal that's entered the MF space and has kind of really captured the imagination of a lot of investors. Any thoughts on this, Vivek and Pankaj?
Yeah, so I think I just had an article researched for Money Control where I had mentioned that unfortunately today people still synonymously treat algo funds and quant funds as the same, though there are differences in both the uh, nomenclatures. Coming to quant funds, yes, their turnover ratios are extremely high. Uh, they largely follow the momentum theme of trading, and though most of the studies do say that the momentum indices actually do the best over long periods of time, but the problem with momentum indices is that their volatility is on the higher side. Their drawdowns, which is basically fall from the peak, is also much higher. And the good thing is that at times they do recover the fastest. Having said that, what we recommend right now is on the momentum side to have at least one momentum index fund also. And secondly, since we count these as thematic investments, which is the momentum strategy, to not have more than 20-25% overall in thematic strategies and not more than 10% in any individual strategy. So, considering the fact that a lot of investors are very new to the market right now, I think post COVID, and they have not seen a long period of drawdown or a fall. I would strongly advise people to have the lion's share of their portfolios in diversified funds like a Parag Parikh or index funds, and to keep strategies like momentum or quants at a maximum of 25% of their equity portfolio, not of the full portfolio.
So,
Yeah.
just to add to what Vivek is saying, at times what we have seen that investors try to chase the returns that funds are given in the past. We generally go with the fund performance in the past, but at the same time, we need to be careful what is our risk profile, what is the goal that we are aiming. So, not necessarily momentum, which is good for one, is good for everyone. So we need to be careful about the fact of asset allocation, and within the asset allocation, how much should be for the long term and what should be for the momentum allocation.
Yeah, absolutely. Okay. So we're running out of time. Vivek, Pankaj, if you'd like to spell out one or two of your favorite strategies or guru portfolios.
Sure. Anil, rather than spelling out the strategy, what I would like to say here that most of us look at asset allocation when we talk about the financial planning. When we talk about the financial planning and strategy, it goes beyond just the asset allocation and the returns. We also need to be very careful about the security of the family. Whether all my assets have been properly written down in the form of a will, or do I share everything with my chartered accountant or with my family in case of any untoward incident that happens with me. The family should have hold of the full record, because most of the times or many times what we have seen that we are not aware about all the assets of a person, and in such cases we'll have to we face lots of problem understanding where the corpus is lying, where the investments are kept. At the same time, health insurance, term insurance is equally important. It's not on the returns. There's no point just earning the returns if you're not able to preserve the returns in the form of a health insurance or the term insurance.
Yeah, absolutely. There are many aspects to personal finance in India which go beyond returns, and in fact, we've documented some of them. So, you can invest in the name of your child, what benefits that has. Many people work in multinationals. They have ESOPs. So, how do you invest? How do you report those returns or those investments? Should you take an education loan? So we have gone well beyond just a discussion on returns into all of these aspects that affect our lives so much. Vivek, any strategy or aspect that you'd like to point out?
Yeah, the one thing which, again, very generic, but why one should invest in their kids' names. This is something which I feel is extremely important, both from a positive side and also from the fact to keep your estate away from your kids. As our kids grow, we're also working. We have, certain ambitions, etc. We keep meeting people, keep getting investment opportunities, and it's very human to get accidents in the process. I mean, investment accidents. So what happens is that when you're investing in your kid's name, you have mentally, emotionally, and even physically, detach the assets from your name. So tomorrow, it's like something where you've ring fence their protected investments which you need for their education or marriage or whatever it is that you need for them. So you personally believe that it is their money. You treat it separately from both an asset allocation perspective. So from an asset allocation perspective, since these funds are for very long periods of time, I think for this allocation specifically, one can be very heavy into equity. Unlike your asset allocation, which could have 30-40%, in this, you possibly might not need to have any amount into debt, in fact. So that is one. Second thing is, the kids, as they grow older or become teenagers, I strongly believe that it is good. It's a very good practice to have them understand personal finance. That's something which is not taught. And the way the social media is today, it is very important to teach them. This is a life saving tip, if I may call it, because uh, I see a lot of teenagers, etc. The kind of advice they get on the internet is extremely dangerous. So, with them having to manage their own investments or seeing how it's grown over a long period of time will help them avoid such kind of disastrous avenues of investment.
Yeah, it builds compounding early in life.
Yes.
And even from a tax point of view, until the age of 18, the child's income does get clubbed with the parent,
Hmm.
but after 18, that is not the case. So if a substantial corpus has been built in the name of the child, then after 18, they can really utilize it for their own financial goals without it presenting a big tax bill. Um, Fantastic. So with that, let me just demonstrate how you can download a copy of this book, and then we can conclude. So just give me a minute. I'll just quickly get the link. Yeah. Um, is my screen visible?
Yeah, Neil, it is.
I've displayed the link here. Yeah. So anyone who would like to download this book, it's as simple as going to this link here, um, and just click on download the ebook now. You have to enter some details, very basic details, submit, and you'll be able to download the ebook completely free of cost. So please go ahead, please go through this book. It's a fantastic asset to your money decisions in the coming financial year, and in fact much beyond, because many of those decisions actually will affect very long periods of your life. So before we conclude, any final thoughts, Vivek or Pankaj?
We are on mute.
Vivek, you're on. Yeah. No, still on mute, I think.
Oh, okay. Sorry, I was on mute. So one big thing which I would like to tell people is that people, especially who read this book or the guru portfolios, is that do not blindly follow any guru portfolio. Let us understand that these people have had a very strong experience in the markets earlier. Personally, I have 80% in my of my corpus into direct equities, but that's because I've been doing this for the last 25 years. Today's market fall, a lot of people come and say that it's a market crash ho gaya, ye ho gaya, but these are very par for the course. This is something which has been long pending, and I don't think this is, you can even call this any proper correction yet. So do not follow any guru blindly. Follow what, play the game as per the way your rules are defined, not as per someone else's rules. So that's all that I would like to say.
Yeah. So this
Yeah,
book is
absolutely.
a very good collection of all the aspects of the financial planning one can look at. It can serve as whether it's a starter or someone who's experienced. It's equally useful for all the investors in the market. One should really look at the books from all aspects. It would really help a person in ensuring that he's not missing out few aspects which are critical, which we generally miss out in our day-to-day life. One, the books and then the infographics of the books are superb. uh, a few of the infographics are worth 1,000 words. It's not like you need to go through the lengthy stories. It just one page can give you lots of interesting insights about the financial aspects.
Yes, absolutely. All right, folks, thank you so much for joining us. Do give me your feedback. I'm available on social media, on Twitter at Actors Day, or on LinkedIn at Neil Borate. Or you can also contact Vivek or Pankaj. Please do tell us what you thought, liked it, disliked it. We are very keen to hear your feedback as well.
Thank you.
Thank you.
Thank you.